So without further ado, I'd like to introduce Joe Daniels again, who will kick off our venture panel. Joe, why don't you tell us a little about yourself, and let the investors, again, give an introduction to themselves and kick off some of the questions.
You got it. So again, I'm Joe Daniels. I'm a corporate and capital markets partner here at Jeffrey Bowen. And basically for 19 years, I've been representing private equity and venture funds and startup companies and public companies, and helping companies get funded in angel and venture capital and other private rounds and IPOs and then other public offerings, and every sort of handling every sort of merger, acquisition, partnership, joint venture, commercial agreement you can imagine. And I act as outside general counsel for all these companies when I represent them, and to some extent the funds. And I represent about 75 companies and funds, probably worldwide right now. It goes up, by 5 or 10 companies a month, and 4 or 5 die off. And I've been, like I said, I've been doing it for 19 years. That includes 8 years during the dot-com days here in the Valley, and I've been in New York for 13 years. So I've been doing a lot of these deals, and I sort of know what these angels and VCs do. And why don't we just get straight to the panel? The panel, my part of the panel is just sort of the general questions that any entrepreneur might have about angels and VCs and their business. So why don't we all introduce ourselves and talk about what your fund does or what you invest in and what you're looking for, starting with Asher.
Hey everybody, thank you all for coming out. My name is Asher Leeds. I'm actually up here from Los Angeles. I'm an angel investor. I don't have a fund or anything, just invest my own capital. Generally, I'm industry agnostic, kind of look at a lot of different things, but my recent investments include companies Mogul.com, Events, Thrive Market, Arsenic, just off the top of my head. So, but kind of broad range, and it's a small little thing.
I'm going to ask all the speakers just project a little bit, so very long room.
Yeah, I'm Paul. I'm at IDG Ventures. We do consumer and enterprise software Series A investing in the on-demand space. A few of my experiences include Sesh, which is a tutoring startup, seed funded, and I'm an advisor for that. And for IDG Ventures, we have Soothe, recently raised their $10 million Series A, and then we're also investors in BP, which you guys may know as a soon-to-be unicorn.
Of course.
I just heard there was free sushi.
Oh, you don't want to?
I'm not investors.
Okay. Hi, my name is Vishal Arora. I work at Bloomberg Capital. It's a classic early stage venture capital shop based out of San Francisco. We are actually specialists in seed and Series A rounds, invest somewhere between $500K to $5 million. We're currently investing out of Fund 4, which is $200 million. And just to tell you a little bit about the history, we've been around for 14 years. Our Fund 1 was $36 million. Our Fund 2 was 91, Fund 3 was 150, and our Fund 4 is 200. So the company's fund sizes have grown as the company has progressed over a period of time. In terms of a geographic focus, we're kind of a global VC. A lot of our investments are here in the US, but in the past we've actually invested in Canada as well. In fact, 2 of our largest portfolio companies, Hootsuite on the social media management side, as well as Trulio, which is an identity verification solution, are both based out of Vancouver in Canada. We've got a separate presence in Israel too, separate offices over there. Out of a total investment professional team of 9, 3 of them are based in Israel, and in the past we've been investors in Europe as well as India. So it's a global VC. In terms of sector focus, we focus on 3 key verticals: enterprise, fintech, as well as consumer. Within enterprise, in the past we've done investments in the infrastructure/big data analytics space. One of the prominent companies in that sub-vertical is Nutanix, which is the market leader in hyper-convergent solutions. Within enterprise, we also do a lot of security investments. In the past, we actually invested in a company called Cyvera, which got last year acquired by Palo Alto Networks for $250 million. And then we do a lot of software investments as well within the enterprise space. AppBoy, Double Verify, a couple of stellar companies in that specific sub-vertical. We've done a lot of fintech investments in the past as well, but our key focus right now is in the panel consumer investments, and in the past we've done a lot of on-demand economy investments too. Three of the companies that we have invested in the past are one, Saucy, which is an on-demand alcohol delivery solution, Campaign Living, which is actually a vertically integrated furniture delivery solution based out of Oakland, and the third company is Wondercar, which is actually a ride-sharing application, kind of competitive to Uber and Lyft, based out of Hamburg in Germany. So that's a little bit about Plumber Capital. And my background essentially is venture capital. Prior to this, I was doing investments at Salesforce.com in the corporate development and the ventures team. And prior to that, I was at Goldman Sachs doing mergers and acquisitions, IPOs, private placements, and debt offerings for tech clients, primarily based out of Silicon Valley.
I'm Heather Crawford. I come with a couple of business cards tonight. I'm a member of the Band of Angels, which is the oldest angel investment group in Silicon Valley. It's been around since 1994, so I do individual angel investments through them. Primarily, the group works on enterprise software. We also do a lot of life sciences, and then a little bit of what's new and what's coming. So we, much like the presenter showed us tonight, kind of know that the 55 million worker number is closer to what is coming, and we're very interested in that. To be honest, we haven't made a lot of investments in this area because it's so new and it's not something we understand very well, so I'm hoping to learn something tonight. We're also keenly aware of the tail, how few of the workers who are available actually know about this company, so the opportunity to differentiate yourself is huge. The other reason I'm here tonight is I'm on the staff of the Angels Forum. So the Angels Forum was started in 1997, and it's a very different group from the band. It meets weekly. It has only 25 members, does deals very quickly, and does them very intelligently. So if you're looking for a very focused group, that group is looking for things that are more closer to Series A, but also very creative in how they think about what's coming next and where they want to put bets. So I'm happy to talk to anybody about either of those opportunities. And then personally, I come from Caltech. I did econ there. So I find this whole shift intriguing just from the studies I used to do, as well as the fact that I can't imagine what I would have done without the mentors I had in my career. And I'm a little bit concerned about how folks that enter this gig economy working independently and don't experience that, where will they be in 20 years with their skills and abilities? So that's also on my mind.
Okay, I guess I'm next. I'm Rick Gibson. I run a portfolio of my investments called Hot Ventures, one word. Hot because I live in Arizona, although I'm former Californian of 30 years. And actually I've been doing startups since, believe it or not, the 70s. I was in my first tech startup in the early 80s. And then a lot of you might know Bill Gross, who runs Idea Lab in Pasadena. I'm his oldest partner going back to 1984, like a decade before Idea Lab was founded. Bill and I had a couple of really good exits together. I've had, on my own, about 6 exits since then. And I focus on a really wide range of technology, meaning sensors, healthcare, IT, materials, transactions, everything. I just look for companies that have really awesome assets that are not yet fully exploited, and I love working with companies. When I spend my funds, sometimes I end up serving on boards. I run out of money here and there, but I'm truly passionate about building fast growth tech companies.
I'm Michelle Tandler, and I'm here as an associate on behalf of Trinity Ventures, who has done a number of investments in the on-demand space. Most notably here, we have Xerx. So we were involved in the Series A and B, and then also debatable whether or not they're really on-demand or not, but Eat Club is one of our investments. They're pseudo on-demand, and Relay Rides, which is increasingly becoming on-demand, as you can like book instantly now. And my background is I actually worked at Yammer for 2 years. After that, I went to business school, so I just graduated in the spring. And I started my career at McKinsey.
Great. David Lane, Founders VC, which is affiliated with Founderspace. For those of you who are in the accelerator world, we've been fortunate to be recognized by Inc. magazine as one of the top 10 accelerators. And then Forbes earlier this year came out with their list of top accelerators in the Silicon Valley for companies coming from overseas, and Founderspace was identified as the #1. It's right near the Caltrain station. We've got a lot of companies who come through our platform in the sense that we have 60 partners around the world their local incubators, tech centers, government labs, and we work with them and their team. We push our education out to them. We also bring about 60 to 80 per year to our physical accelerator. So we've got an increasing amount of on-demand companies coming through. And we also bring a lot of foreign investors from, I just came from there, a group of about 21 investors from China. We're meeting with some of our companies, some of whom are on demand. So it's a very appropriate topic.
Great, it's an esteemed panel. So what are you guys seeing in terms of trends in angel VC investments in the on-demand space? What types of companies, bigger, smaller deals, deal sizes, valuations, that kind of thing. Anybody who wants to chime in?
I think everything's getting fussier. So when this space started, it was like anything that was interesting or cool, provided a service, was fundable, and they were early adopters that gathered around to use the product. If just as an opening comment, where we end up today is now you have the lead company, the number 2 company, and in a lot of cases 10 or 15 followers. And so I think it's finally getting to where the consumers are getting a vote, and the public and the great masses are getting to say which products are better. So I think competition is great. It keeps the big guys at the top working harder and gives a chance for other new areas to be discovered.
Yeah, I would say that the barriers to entry have been lowered in the past over the last 4 to 5 years with the proliferation of devices, as well as the internet usage gaining prominence. It's led to lower transaction costs. It's actually led to an unprecedented situation where you could scale up the business in a matter of days rather than a matter of years. So the barriers to entry are pretty low. If you've got a great idea, you could actually partner with the Postmates, and you could partner with the dispatch and get your local fleet of drivers. You could get up and running with your backend infrastructure in a matter of days. So barriers to entry are pretty low. And this has actually led to a lot of players coming into specific verticals, leading to intense competition, both actually on the supply side as well as on the demand side. If you pick up the ride-sharing market, on the supply side you've got drivers, and then on the demand side you've got customers, and companies are intensely competing both for freelancers as well as customers. So there's intense competition, and in order to actually differentiate within this highly contested market, companies are focusing on what everyone is talking about. That's hyper super specialization. So within like a crowded space with for instance ride sharing, or let's pick up the example of food and beverages, everyone's trying to find that small niche and trying to create that incremental value in a really crowded space. So if you look at the food and beverages market, there's on-demand alcohol delivery solutions, there's on-demand grocery delivery solutions, and if you look at restaurant delivery solutions, you've got like Grubhub and Seamless, and you've got companies focusing on organic food delivery, companies such as Prig, companies focused on chef prepared meals such as Munchie. So everyone's trying to hyper specialize, and that's how they're trying to create incremental value in a crowded space. And I would say, like, for entrepreneurs trying to have an idea in the on-demand economy space, the best way forward is to actually go for hyper specialization in an intense, and that's how you will be able to compete. But have the belief that the market could actually expand over a period of time. Have a solution that could actually alter user behavior. Uber, when it started off, actually started off as a company which was, deemed to be contender, actually could be a market leader in a niche market. Today, because of the fact that it's been able to alter user behavior, the market size has expanded immensely. So if you want to kind of compete, you have to be hyper specialized solution in a niche field with the belief that that market is going to expand in the near future. And as an entrepreneur, the best way to get forward is actually move aggressive, be really, really fast, and compete vigorously both on the supply side as well as demand side, and create those network effects. So if you pick up the ride-sharing market, you get a loyal base of customers, which will get you more freelancers who get attracted towards the platform. You give them more price, you get better price, you give them a better volume, and you get more freelancers, which will actually improve your quality of service over a period of time, which will actually get you more customers. So get your network effects going up and running in an aggressive manner, and that's how you succeed in this space.
Excellent point. Please, Asher.
One of the things that I'm actually seeing, it's kind of interesting, is people come through and saying, well, we have this on-demand app and all that stuff, and I think there's somewhat of a definitional problem with what people have, and like you have apps like Thumbtack and Service and House, and I think HomeDroid, which is no longer around, and things like that. But the reality is some of these things aren't really on demand. They're more like scheduling apps. And I think you have to really differentiate, and it's kind of disappointing when someone says, oh, I have this great on-demand app, it's going to do something right away, and then I get it, it's like, well, no, this isn't on demand. It's something I have to do and schedule for down the road. It's kind of, it would be nice if we kind of really understood what's on demand and what's scheduling. And as you say, in this differentiation, that we really started differentiating between these two things, because I think they are very two different markets.
Is that intentional? Sorry, Asher. Is that intentional, or they don't know they're mischaracterizing themselves?
I don't think that I can't tell you. I personally think they didn't understand. I think they think they're on demand.
Michelle, what do you think?
I think that they're probably using the word like Uber for something, and the fact that it's coming from a mobile device, it kind of feels similar. So, and on demand is so much, it's such a cool word, right? Not just like, oh, we made an app to do something that you could have done via your computer a couple years ago. And I would say that's actually, so this may be like a little controversial in this environment, but Trinity is kind of saying that it's gone a little too far. Like, you can look at my colleagues Phil Carter and Patricia Nakash have published 2 pieces in TechCrunch, both this summer and a year ago. One was called like the opportunity in mobile commerce, like the next mobile commerce app worth $1 billion, and then they updated the market map this year, and they're kind of saying there's going to be a bit of a shakeout in this for exactly what you're saying. After there's so many companies saying they're on demand, a lot of them aren't on demand at all. And then a lot of them are on demand, but they're not really adding much value over what existed before. So half these things that are now on demand, people are willing to schedule them, or they're willing to go around the corner to go get them. Do you really need to have all your alcohol, your blowout, your massage, or all these different things? Do you need them on demand? And some people do love them on demand, but the question is, do they need them, right? And if you are just playing in the world of we're going to create a better experience, but people don't want to pay 2x for that, you run into a really big problem with unit economics. So I've now looked at lawn care on demand, all the beauty on demand. I just have companies coming on demand all the time. And then we ask them well, how much are you charging? And they're charging 2 times the amount as if you were to go to the nail salon around the corner. And we're just wondering, are people really going to be willing to pay twice as much for it? And then but the problem is, if you don't charge twice as much, you don't cover the unit economics of paying someone to come to you and back. You're basically paying for someone to take an Uber to you and back. So you have to sort of build that into the cost.
There's only one way to find out, right? You have to write a check.
Yeah, I don't know. I just think about Instacart, for example. There's so many questions about them. They're growing like gangbusters, but I've heard through the grapevine, I have no idea if it's true, I've heard they're just losing something around $7 on every delivery. That to me actually seems about the right number, because if you think about, I think you pay a little fee, $4, you may tip in addition, but the cost of someone to basically drive to you and maybe one other person, and the cost of someone to shop for 15 minutes, that seems about right, that it'd be a loss of about $7 per delivery. So everyone keeps saying, oh, once we get to scale, once we get that route density, then we're going to be making money. But it's just really tricky, because you have to reach incredible scale.
I mean, they could just ask Webvan, right? It doesn't work that way.
I think with Webvan, they also have the
infrastructure
inventory issue, yeah.
Yeah, maybe a glimmer of hope. One of the things I'm seeing are, I don't know whether you call it C to B or W to C or W to B, but there are opportunities for crowdsourced working in linking to enterprises. So one of the more interesting thing I saw was how you hire attorneys, right? This is a common freelance thing through a marketplace, but their target customer are law firms. They're not out there trying to convince consumers to hire an attorney online through a marketplace. There's a ton of little things like that, and having come from an enterprise world, I started my career with Prudential, worked in some really big companies and some really small ones. Freelancing is not new. at all. I mean, it's been out there for a long time, and it's a great way for companies to supplement their workforces. So if you haven't considered that and you're looking at how you want to do something on demand in the gig economy, that might be an opportunity to sort of think about, is there an enterprise link to your business? And there might not be. Don't try and fake one, because I don't know that that's a hot trend right now. But if you haven't thought about it, give yourself 30 minutes and a glass of wine and see what bubbles to the top.
Companies have to be able to provide a true advantage to the consumer, not just a way to convince the public that it's cool. Because I'm sure that virtually everybody in this room has used Uber one or more times. If you look at Uber, just because I have to
Or Lyft.
Lyft, yes.
Yeah, or Lyft, sorry. But it's an improvement. I hope I'm not offending anyone in the room, but I think it's an improvement over a taxi cab. I mean, I make that statement. Never had a chance to know that it's going to be 3 minutes, 2 minutes. I don't have to take my wallet. I mean, it is an improvement over taking a taxi cab. So, of course, the drivers don't get paid that much, and that's another whole social issue. But if these companies aren't actually creating a consumer advantage, the user advantage, I don't have to say consumer, it doesn't actually have a built-in user advantage, then I don't think they have anything to stand on. They don't have a foundation.
So,
Okay, wait, there's going to be a roundtable
I-
about the on-demand economy coming up, and you guys are participating in that. This is more the VC. Let me move on to just a couple more questions. There'll be a practical application to, there's going to be other times to talk about.
Okay.
So you have a lot of entrepreneurs around here, obviously. They probably want to know, how do I find the right angel or VC for me to fund me at whatever stage I'm at? What kind of materials do I put together? Is it a 15-page slide deck or one-page executive summary? What do I do? And how do I get it to you? How do I get a meeting with you? And how do I follow up with the meeting and close? Anyone who wants to start?
I'll speak to that a little bit. I get 100 emails a day since I'm the most junior person at my firm.
Lucky you.
and I think there's kind of a set of things you should just do that gets you credibility, which is the warm intro really matters, and doing it all at once so that you're not kind of like going to one VC firm after another. You can get some momentum going that way, and then I guess so essentially prepare, like be really ready to start an all-out war to get like 20 introductions all at once, really solid introductions. In terms of what you send, I think it's really important that you just send like a credible, like beautiful looking slide deck. Surprised how far that goes over, a long business plan or a lot of text. Or
So you like a lot of pictures and videos and things like that? Visually,
Bullet points.
I mean, if everyone's making software and UI is an important part of software, if your deck has poor UI, that says something.
So you got to have the deck. You also should have a 1 or 2 page executive summary. And somewhere, and I used to teach business plans 10, 20 years ago. I think business plans are passe. You need a plan to run your company.
Yes.
But to send a prospective investor that's not involved in your business a business plan, you're not saying that.
Don't send it, yeah.
But you still do need numbers. You need to have them, because if you haven't figured them out before you try to get people interested, and I think it's all about momentum. So I use momentum with a really big M. It's got to be the first exposure to the investor is, hey, that's interesting, and that investor's got to move from, hey, that's interesting, to let's have a call and see if we're further interested. So you have to be enthusiastic but not crazy. You have to be prepared. You have to be honest, straightforward. But the biggest thing that's going to happen in that first conversation is going to be, so what's the difference between you and what's being done so far? The differential. And if you can't explain that differential quickly, to start with, in a sentence or 2 or 3, you're dead. And if you don't answer that question directly, or any question directly, like, what were your sales last year? Well, last year was a hard year, and we just got started. No, your sales were X. Answer the question and then explain. But you have to know the differential between you. Here's what's been going on. That's the problem. here's what we're doing, and here's why we're particularly good at providing this new way of doing it.
Just on
Yeah.
how to submit, so most of the groups do have, the angel groups especially will have websites, and there usually is somebody, and keep in mind the angel groups are usually people that are retired, they have large networks, and they might send things out. Generally, your stuff will get read. I apologize in advance if you don't hear back from folks, but there usually is somebody who reads it. Make sure if you're gonna submit that way, the warm intro is much better, you're here tonight, so hopefully you'll have the opportunity to generate that contact. But make sure what you send is a pitch deck and not a marketing deck. If you can't explain kind of what your business or product does in 2 or 3 slides, try again. Because they're only going to read about 10 slides. I read a 25-page, absolutely beautiful deck on the BART on the way here that didn't have a single number in it or a go-to-market plan. So I sent the guy back a note because I kind of know what he's doing. I'm sort of interested and said, hey, look, you need to turn this into an investor deck, not a marketing deck. Give me a call tomorrow, and we'll see if we can work it out. But you need to have a go-to-market strategy. You need to have something about how you make money and how much and how many customers you're going to need and where you're going to find them.
How do you get the warm intros that you're all talking about?
Well, you come here. I think that's how you start.
Lawyers, accountants,
Yeah.
events. Their Funding Post is probably the best event in the country, but it's not the only event in the country. So you need to be out even in your industry with people that have relevance. So if you're in a particular field, go to events that have to do with your particular industry, and go to them constantly and get 1 or 2 or 3 leads from every event you go to.
I'm going to slightly build on that and say, I don't know, as a founder, I think it would be really hard to go to events all the time. And so I personally, as looking at Series A and Series B pitches, tend to lean on my seed investors the most for intros. And I think that the best seed investors are highly networked into the institutional funds. They have their preferential relationships. So I think if you get in with the right angels, you get in the right seeds and so on, and they'll help make intros. So I think starting, you kind of want to start on the right foot, and it'll really help your funding over time. Also, I would say the angels are a great resource for giving you feedback on your deck. That's their job, to help you get funding down the road, right? So going to your angels, saying what do you think of this? Walking them through it, they should be really helpful. I would also mentally, sometimes I get really frustrated when I'm getting pitched where I'm like, man, I don't think these founders understand my job. I don't want to sit there and be charmed. I don't want to become friends with you. And they all are asking me all this stuff and telling me all about their background, or just going on and on and on. And I don't think they realize we have 15 or 20 more minutes on this call, and I'm going to need to tell a partner at my firm a couple key things to get them interested. And so thinking about it through the lens of, okay, this is an associate, or even if it's a partner, what is the information they need to tell their partnership to get their partnership excited? And there's a very specific set of metrics. What is your TAM? Who's on the team? What are you doing? What are your metrics so far? On consumer, we're going to be wanting to know your growth rate and how many users and your engagement. And if it's enterprise, we're going to want to know how many customers do you have, what's your customer pipeline, and who are those customers, and what's your average size of contract. So I think you can actually really get to know this if you look through some of the there's tons of resources online. And I think Y Combinator does a great job of this, particularly their decks are fabulous. At any deck I see that's been from a team that's been through Y Combinator, it's I know what I'm getting, and I'm so much more excited for that call because I know I'm not going to have to ask a million questions. But probably 9 out of 10 pitches, I don't get the information I need, and I have to then either follow up via email or stop them short and then start asking them.
And I would just say for VCs, absolutely every single entrepreneur should have a strategy around the entire fundraising process. You should have 3 or 4 target VCs that you want to get funded with. And then prior to that, you actually should be talking to 20, 25, 30 VCs. Go ahead, be a fool, get thrown out of the rooms, and be wrong. Don't be afraid to be wrong. These guys are incredibly knowledgeable, incredibly analytical, and they're going to give you feedback, which is going to be hard, and keep incorporating that, keep iterating on the deck, keep talking to people, and so that after a period of a month or so, when you're actually completely at ease with your pitch and you approach those 3 and 4 target VCs, you're at the top of your game. And different VCs have got different personalities, and the sector that you're actually trying to get in is actually going to define what you're going to present. If it's a consumer-oriented VC, You want to be a little bit more, friendlier. You want to be a little bit more visual. The font sizes should be nice. If you're like kind of focusing on, an enterprise VC, incredibly analytical. You need to be at the top of your analytical game. Get the numbers in, get the customers in, value proposition, TAM, size of the market. If you're talking to a consumer-oriented VC, you got to talk about the psychological sense of how this solution is going to be, of appeal to a certain customer. So there are different things that you need to be aware of, but and no one is going to actually be able to tell it to you in 30 minutes, 40 minutes, 50 minutes. The only way to do that, in my opinion, is to keep going through iterations. Day after day after day, keep getting rejected by VCs, and then when you actually get to those 3 and 4 target VCs, which you actually want to get funded from, you're at the top of the game.
And
Okay, well, let me just follow up on that, and then I have a question for Sandra over there. So I've heard two of you say it's really a good idea to identify, let's say, your top 20 VCs that you want to talk to. Try to set those meetings all within like a week or two. And I've seen some people advocate that one big reason why is because number one, you don't want to get one term sheet and then get the next one 3 months later, because you will have had to have rejected the first one to be able to compare the 2 different deals. So you want to have something to compare it to, right? To create an auction contest. What about if one of the VCs that gives you a term sheet wants you to syndicate? Like, I'll put in 3-4 million, but I want my buddy over there at Northbridge to put in 4 million too. Do you think that creates a downward pressure on the valuation, or it doesn't have any effect on valuation, or good idea for the founder or not?
I don't think VCs mind that, to be honest. I mean, most of the VCs actually do want to enter syndicates in order to minimize the exposure to a certain company, unless it's a company that's just hitting it out of the park and you want the entire pie. I don't think most VCs mind it. For instance, if you're looking for a 10 million raise, and let's say the limit of the VC that you really, really like is to do at the most like 4 to 5 million in Series A or like a seed stage, then they would want actually you to be working with syndicates. And then if you've chosen a lead, like you should be working with the lead VC to build the syndicate. If you go with the lead VC, they will help you build a syndicate as well. They have their partners, they've got the angel investors, and they've got their preferential syndicate VCs, and they'll make it work. I don't think VCs really mind that. At the early stage.
That wasn't my question. I think VCs do like that because they like to sort of control who they're putting around together with, rather than having the founder go out and pick other people that are not necessarily their friends and so forth.
It depends on
let me ask Sandra here.
who the syndicate.
So
who the
I
syndicates
think
are.
you just went through a fundraising experience. Can you share some thoughts on that, on how it went?
Yeah, fundraising. So my name is Sander. I'm one of the founders of Thumbtack. We've done a lot of fundraising over the years. We've had a long journey. I've been at this for 7 years now. And it's funny to hear the VCs talk about it, because in many ways what you guys are describing sounds like such a straightforward, rational process. And in many ways what I've found over the years is that there's a lot of like random chance and luck involved in the process on the entrepreneur side, and surely on the VC side as well. So our fundraising journey was $500,000 friends and family round in 2008, and then we were out raising a seed round in 2009, and we went to a few different forums. We went to the Open Angel Forum back then. Y Combinator had just started like 6 months or something before we started, so that wasn't a really great to join. So we went out and we raised an angel round, and we were first-time entrepreneurs. Nobody knew who we were. We had just moved from the East Coast. We were all young, had no track record, and really what happened was randomly one person, Jason Calacanis, love him or hate him, he looked at our team and for some reason got attached to the idea, and like looking back at the reasons why he got attached to it, they were like totally random and not related at all to our vision, but for some reason he just got attached to it. And then he invited us to an Open Angel Forum where we raised our $1.2 million seed round. So that was like very serendipitous. And then we went out to raise our A round in the fall of 2010, I suppose it was. And that was really tough. So we did exactly what Vishal recommended, which was go out and find your top 3 or 4 VC firms, but we did it in the opposite direction from what he suggested. We went out to them like immediately because we were like, oh, these are the guys we know, and they're gonna, we have traction, we're gonna get a raise. What happened was, for a wide variety of reasons, they all looked at us and they said no. And so suddenly word got out that Thumbtack was out raising and the best VCs had said no. And so then we almost didn't raise and we almost went out of business. So we then talked to more than 50 VC firms and had plans to lay off like the entire company. We had a team of 200 people in the Philippines then, and it was coming up to Christmas, and we were gonna like have to lay them off. So at the last minute, we had a term sheet given to us and revoked, and at the last minute, a company called Javelin ended up investing in us, and so kudos to them for saving our butts. So then that was like a many multi-month long process. It was this harrowing thing. And it's funny, since then the fundraising process has gotten shorter and shorter each time. That was the hardest fundraise we've ever done by far. So we then went on to raise our Series B. 18 months later, we were so traumatized by that experience that all we cared about was revenue. For the next 18 months, we had like a revenue number up on the wall, a weekly revenue number. We were like, if we just get to that, we are going to achieve freedom, and never again do we want to be at the mercy of investors. And so we did, and that was great. So we went out and talked to our favorite 5 VCs, and Sequoia said yes. And that was like a huge turning point in the company, which actually I hadn't expected. It's funny. Before I started all this, I was a very I believe deeply in like the efficient market hypothesis. If there's a $100 bill on the ground waiting to be picked up, it will be picked up. And for many reasons over the years, I've become disabused of that. I've seen inefficiencies in the market that we've had great advantage from, and inefficiencies that we've suffered from. And for years, we were like building the company, and we were like, this is working, the unit economics are working, we're acquiring people at scale in new ways, but like nobody in the outside world was seeing it. And then boom, like Sequoia invested in us out of nowhere, and suddenly like, everybody wanted in. So, 9 months later, we raised a Series C from Tiger of $30 million, and then like another 6 months later, we closed like a $100 million round from Google Capital over the course of like 48 hours, basically, from just like getting to know what we knew them beforehand, just like saying we were interested and then closing it. So it's this funny like change in expectations, and we've seen like truly how wild and fun ride can be, and how kind of like crazy and driven by random chance it can be. So there are certain strategies.
That's the typical story that I hear.
Yeah. There are like better strategies than others, but at the end of the day, what I've seen is that like your core business metrics drive everything in the fundraising process, and like that's what VCs get attached to, at least like in the 8th round and beyond.
In the exits that I've been involved with, there wasn't one of them where we didn't contemplate closing the company at least one time. And so when they say this isn't easy, it isn't easy. Persistence and keep moving forward is absolutely the rule. You gotta, we were talking about iteration. It's all, I learned from the best, it's all about iteration. It's being wide-eyed but not being naive, making sure you know more about what your company's doing than anyone on earth, because that's what the market is these days. And keep moving, but keep being open, and very much open to anomalies and to things that come from nowhere. I remember, when we had startups in the 80s and 90s, there was always someone who came in who knew a whole bunch of people, and that person ended up introducing us, and you never knew who it was. I mean, so you had to be wise yet open both, because you didn't know who your magic good luck was going to come from.
I thought one of the most telling things you said was, that you had those small group of VCs that was your preferred group, and that didn't happen, so then you went to 50, right? So you, in a sense, you made your own luck, because that's a lot,
Well,
that's a lot of work.
I wanted to ask, I mean, if you had the chance to do it over again, would you have gone to the 50 first to avoid the, the pressure?
It's tough. I think if we had to do it over again, we would have done what we did in our B round, which is like be much more informal with our initial conversations with our favorite people at first, rather than like saying, all right, we're out fundraising, here's our like big deck, and throwing it out to the world. So instead we would have just had like coffees with a few partners that we knew and like said, all right, here are our metrics, what do you think? We're considering fundraising, do you think the time is right? And had we done that in our A round, I think there wouldn't have been this like huge signal in the VC community that, Thumbtack had failed in its fundraising, and now like you don't want to invest in them. Instead, it would have been this much more like informal, like nobody would have known.
But I think that's key in the sense of I've been in the venture business since 1987. It used to be very different, like what we're talking about, but now venture capitalists have moved more towards, I'll say, momentum investors to a certain extent. They're looking for metrics, not of here's 3 pretty cool people. In general, they're looking for businesses that are moving, because you can buy into those, maybe at high prices, but exits are quite high too. And so I think it's great where entrepreneurs take time, get initial traction, and have the coffees with the venture capitalists. And you have to identify venture capitalists who have passion for your area. You can do that by their websites and see what they're interested in, see what their companies are, if they're on demand or semiconductor or wherever they might be. But you go and have coffee with them, you can get introduced through attorneys, accountants, etc. And you ask them, here's what I do, is this something that interests you? If it interests you, then you ask them, what do you look for before you want to invest? And they'll give you a checklist. Most of them will, especially if you get to the general partners, because they know what they want. And it's like X, Y, and Z. And then you keep them up to date as you go through and you tick off those milestones. So then when you're ready and you have maybe 4, 5, 6 venture capitalists who you've been getting feedback from, they'll actually help you with their businesses, with your business. Sometimes they may even make introductions to corporations or others who you can leverage. You come through that, and then you know who's going to have passion, and then who will stand behind you if you've checked their tick marks that they've given to you.
And just to add, because I know we've been hearing a lot now from the VC, so kind of from the, the grassroots angel people. What I'll tell you, what really kind of works, at least for me personally, and I think a lot of others. You go to a lot of events like this, and you meet people on the panels, the VCs and the angels, and it was kind of said before, Michelle, by the way, I have to have your diet because you have the energy that's unbelievable. But you want to, you have to get your pitch out, and I think Rick had said this. If you can't get your product, your service, whatever it is out in 30 seconds, possibly even 15 seconds, and get that understood, then you probably shouldn't be doing what you're doing. And by the way, when I say get your pitch out, you shouldn't even really be giving a pitch. What you should actually really be doing is telling people what you do. Don't be asking for money. You should be saying, hey, here's what I'm doing. The best pitch I ever received was when I wasn't pitched. It was at events like this. People were, out there doing their products or services or whatever they were doing. And it was at a table that they had, and they were trying to get memberships. It was for a company called Thrive Market. And they wanted to get their people memberships. And I went up to it saying, oh, this is cool. And I wanted to sign up. They told me what they did, within 15 seconds. And you either got it or you didn't. I thought that was an amazing thing. We delivered non-perishable, organic, paleo, and vegan foods at 50 to 25% off. retail prices. I'm like, wow, great. That's, you know, I don't have to worry about spoilage. Sounds interesting. You know, I would definitely want to sign up. By the way, can I invest? It wasn't even a founder at that table. It was someone who worked for the company. They weren't even raising capital. I figured out how to get in there. I closed out their seed round. But that's how you pitch. That's the best way to pitch to somebody. Don't be pitching. Do it where you're telling them about what your service is, what your product is, what you're trying to do. Asking for advice, asking for, wow, this is, you know, is this something that, it's something you can be helpful to, you know, that you can, you know, give me some of your expertise in, that you can give me some guidance in, that is something you'd be wanting to, you know, sign up for. That's the best way to be pitching. Then, you know, you get the right angels, and then, like Michelle said, you know, with your angel network, your angels, like people like me, then have their networks of people that they know, and they can bring you to the VCs that they know. And you know, like me, I'm expanding my network. That's why actually I'm from LA. I'm up here in San Francisco, expanding my network too, to be, you know, more beneficial to the companies I invest in. So that's the whole idea of what the ecosystem is trying to do, and that's what you guys should be trying to do with what you're, you know, getting funding and getting introduced, and you know. So that's the purpose of the events thing. Like Michelle said, I know it's difficult, but when you're being an entrepreneur, it's a 24-hour a day, 8-day-a-week job, not 7 days, 8 days. You know, 26 hours a day. So that's my 2 cents.
All right, very good. I think we only have time for one other question. So I'm thinking of one of the questions I always get from founder or CEOs. What valuation should I go on? Whether am I going from a seed round, or am I A or B? And you know, I mean, I think about what sub-industry they're in, and I think about other deals I've seen, and I just give them some subjects, you know, really a range, subjective range. How do you guys figure it out?
I think it's all about comps. So we all know, I'll start with that concept. So we all know about the house next door. And so you have your house, you put it on the market. It's just a good metaphor to get this concept going. So, you know, you don't want to be, if your house is the same as the house next door, you probably want to be in the ballpark unless you can claim some differential. You need to look around at other companies that are akin to what you're doing in your market. And I think that, frankly, that initial valuations, the valuations in early stage we worry about that too much. Because frankly, the idea isn't to try to get as high a valuation as you can in your first valuation. The idea is to raise the money you need, work with people that you know are going to help you, and prepare yourself for growing the company, growing revenue, and it's all about revenue. You want to put yourself in a position, it's sort of like part of your schooling. So find people you know you can work with, look to see don't be an outlier. I think if you're an early stage company, find out, see what other companies in your category are going for. You don't want the valuation either too high or too low, because then that makes it another issue. You want the value of what your company is doing and its prospect, where it's going, to be what dominates the conversation.
To build on that, this is probably more important in your angel round. If you're out there fighting tooth and nail for, you know, the maximum angel valuation, you could be putting people off because they're going to be worried about, will new money come in at what needs to be the next valuation. So it's not always about a negotiation and trying to figure out how much I get and how you get. What really it should be at that stage is sitting around the table and figuring out, well, what's our ultimate funding strategy going to need to be over the next, you know, 1, 3, however many years it's going to take for you to get to where you need to be, and making sure you're going to be able to put together attractive deals at every piece of that puzzle. You know, I've seen angel deals at 20 million pre-money for things that were not biotech, right? So you kind of look at that and you go, well, that's really great, but nobody's going to follow. So we can put our little bit of money in, and their next round's going to be a down round. If they get any money at all, and everything's gone. So it didn't really matter how good their idea was, how good their team was. It was their sort of ambition, and I got to get this high pre-money valuation right now. And the there was a lot of people a lot of smart money that looked at that and went, they're going to die, and walked away. And frankly, if they had been at 10 million, I think in the room that evening, they probably would have raised everything they needed and been done. Now, how they felt about that is important, because you could put a lot of blood, sweat, and tears into it, but do think about your valuation in the context of your complete fundraising strategy over a longer period of time, not just how much can I possibly get out of this round. It's a much bigger question than that.
So this is definitely a topic we can talk about for at least another hour just by itself. But we have plenty more to do. I wanted to just give a quick thank you to Joe Daniels and the entire VC panel. Thank you guys, this was great. And now I'd like to introduce Mark Roth, who is going to tell us about himself and kick off the entire roundtable for everyone to participate in.
Thanks, Joe. So I wanted to just give you guys a quick overview of Crowded and what we're doing, and then we'll kick off the rest of the roundtable. So what is Crowded? We are a marketplace for on-demand workers. It's where our app is where independent workers come to find on-demand gigs. So what we're doing is we're aggregating gigs and tasks from all the different on-demand platforms in one place, so that workers now have an opportunity to see, more work in their local area than they otherwise would. Because we found from our research that some of that, which Howard presented, that the number one pain point by far for the workers is that they can't find enough work, or that they don't even know about the platforms that have the work. So there's a big issue with discovery there. So by combining all these gigs in one place, it changes the picture. Unless you live in San Francisco, you're probably going to find enough by joining one or two platforms. If you live in Cincinnati, it might be a problem. So, and what we're doing is, it's more than just ride. We're covering all the different categories, not just ride share and delivery, but general labor, home services, even things like what we call market research, like gig walk and field agent, things that people can use their smartphone for, and they can make money doing quick gigs. The way that this is going to work, as far as from the platform's perspective, is they'll also have a dashboard where the platforms can log in, and the platforms will have access to our worker database, which is going to be very robust as far as worker profiles and their skill set. And so that if you're expanding into a new city and you need a certain skill in a particular city, you'll be able to filter down our database and see what's available. Then you'll be able to message them internally through our system and contact this specific group of people that you need to reach. So a key to this whole strategy is user acquisition, worker acquisition in this case. And luckily, our founding team is very skilled at that. That's our background. We come from a space where that's what we've been working on for the past 7-8 years. That's been one of our focuses. So we're able to target based on the platform's needs, and we're already starting to do that even before we've launched our product. We have an alpha version of our product, which is essentially a training portal for workers in order to educate them and teach them about the on-demand space. And so we're driving users to this platform. We're up at about 10,000 workers in this platform so far, and we're working with about 4 or 5 platforms right now where they're particularly interested in certain key cities, and we're targeting our user acquisition efforts to match their needs. And so we're working with these platforms to already send them workers exactly how they require it. So we are planning to launch the actual app in December, so we'll keep you posted with that. So that's a little bit about what we're doing.